If you've ever watched the markets, you know the feeling, right? Those dizzying highs and the stomach-churning lows. It can feel totally chaotic, super emotional, and, well, completely unpredictable. It's so easy to get lost in all that noise.
And you know what? It's perfectly natural to feel that way. This kind of volatility, it's designed to trigger panic and overreaction. But here's the thing. Underneath the surface of all that apparent chaos, there's a structure. There's a predictable, repeating pattern that drives literally everything.
So what if we could trade that chaos for clarity? What if all these market movements weren't random at all, but were actually part of a machine that we can understand? Okay, let's dive right into this. To get there, we got to look under the hood. We're going to use a framework made famous by the investor Ray Dalio to really get the why behind all these economic cycles. The whole idea is to stop just reacting to the effects and start understanding the cause.
So the core idea here is really simple, but it's incredibly powerful. The economy isn't some mystical beast, it's a machine. And at its heart, it's driven by just a few key parts and countless repetitive actions. Once you see it this way, the whole system becomes a lot less intimidating.
So the most basic part of this machine, it's the transaction. Think of it like the atom of the economy. Every single time you buy a coffee or a stock or a company buys new equipment, that's a transaction. And the entire economy is simply the sum of all of these transactions. That's it. It all starts right here.
But, and this is a big but, here is the most important piece of the entire puzzle: credit. Credit is what lets us spend money we don't have by promising to pay it back later. As Dalio says, it lets us pull spending forward. And this is absolutely crucial because this one act is what creates cycles. And you have to remember, the second that credit is created, so is its alter ego, debt.
And that dynamic, it sets off this predictable chain of events called the short-term debt cycle. It usually lasts about 5 to 8 years. So it starts with an expansion. Credit is easy to get, so spending goes up. But then all that spending outpaces the creation of actual goods, so prices rise. Yep, that's inflation. To cool things down, the central bank steps in and raises interest rates. That makes borrowing expensive, spending slows way down, and we get a recession. And finally, to get things moving again, the bank lowers rates and the whole cycle starts over. It's a pattern that is repeated for decades.
So that's the mechanical why. But what do these cycles actually look and feel like for us as regular people and investors? Let's take a look at the rhythm of the machine. This slide, this just nails the human side of the cycle perfectly. Our emotions map almost directly onto the machine's movements. We go from optimism all the way up to euphoria at the peak. Then we slide into anxiety, fear, and total despondency at the bottom, right before hope starts to creep back in. This emotional roller coaster is just as predictable as the economic one. Okay, let's break that down into 4 clear phases. First step, recovery and expansion. Things are looking good. The economy is growing, profits are up, and investors are feeling optimistic. This is typically when growth-focused sectors do really well. Next, we hit the peak. Growth starts to slow, inflation kicks in, and that optimism turns into euphoria, but also anxiety, because valuations are getting stretched. Then comes the contraction, or the recession. Fear and panic set in as profits fall, and this is when safer defensive sectors tend to be more resilient. And finally, we hit the trough, where the market bottoms out. This is the point of maximum despair, but as the slide shows, it's also the point of maximum financial opportunity for anyone who can see past the fear.
All right, so knowing the phases is one thing, but actually navigating them is a whole different ballgame. So how can we prepare our portfolios to respond to these cycles instead of just getting tossed around by them? This section is all about your toolkit.
Okay, first, and this is a crucial mindset shift. The goal here is not to become a perfect market timer. Let's be real, that's practically impossible. Instead, the real aim is to build a resilient, durable portfolio, one that's designed to get through any kind of economic weather, whether it's a sunny expansion or a stormy recession.
So how do you build that resilience? With a structured approach. Step 1, diversify everything. Asset classes, sectors, countries. Step 2, know yourself. Stick to a plan that actually matches your risk tolerance so you don't panic sell when things get choppy. 3, stay in the game. Invest regularly to average out your costs. 4, keep some cash on hand. It stops you from being a forced seller and lets you be an opportunistic buyer. And finally, step 5, think long-term. It is the absolute best defense against making emotional, short-sighted decisions.
Now, for those of you looking for a more active strategy, you can think about sector rotation. The idea is pretty simple. As the economic machine moves through its phases, different industries tend to do better. So during an expansion, sectors that are sensitive to economic growth, like industrials, often shine. But during a contraction, well, people still need to buy groceries and keep the lights on, so defensive sectors like consumer staples and utilities usually hold up a lot better. It's all about adapting to the environment.
And that brings us to the final and maybe the most important piece of this whole puzzle. You can understand the machine, you can have the best toolkit in the world, but none of it matters if you can't manage your own psychology. This is about getting the odds on your side.
As the investor Howard Marks points out, our own emotions are often our worst enemy. See, the rational investor demands a higher potential return for taking on more risk. Makes sense, right? But the emotional investor, they do the exact opposite. They get excited when prices are high and they just greedily buy anything with no regard for the risk. And then they get depressed when prices are low and panic sell, which is exactly when the potential rewards are the greatest. This slide shows it perfectly. On the left, you've got the rational world. To get a higher return, you have to take on more risk. The line goes up. Simple. But now look at the right. You see what happens during market euphoria? Investors get so optimistic, they completely forget about risk. They'll pay crazy high prices for risky stuff, so the line just flattens out. The compensation for taking a risk practically disappears.
And this psychological flaw, it leads almost everyone to make two critical and very, very costly mistakes. First, at the very peak of the market, when everyone is euphoric and the reward for taking risk is at its lowest, investors are at their most aggressive. That is the moment of maximum danger. And second, at the very bottom, when fear is everywhere and the reward for taking risk is highest, investors are paralyzed with fear. That is the moment of maximum opportunity, but most are just too afraid to seize it.
So the crucial takeaway here is this. Getting better results means you have to break away from the herd. But as this quote from Howard Marks wisely says, that is not easy. It means you have to be willing to look wrong, maybe for a long time, before you're proven right. And that requires real conviction. Ultimately, the economic machine is just going to keep on turning. And these cycles, they're going to continue. They are a given. The only thing that isn't a given is how you'll respond. So the real question this leaves us with is this. When the next phase of the cycle arrives, will you be ready for it?